In today's video, I'm going to be giving you some Canadian ETFs that pay over a crazy 7% dividend. Yes, they exist. It's amazing. Let's get down and let's check these out. Okay, so the first one is the BMO High Dividend Covered Call ETF, also known as ZWC. Its yield is basically 8%, which is huge at the time of making this video. From there, it does have an average trading volume of 198,000 shares per day, so you can get in and out of it quite easily in most cases. And its MER is 0.65%, which just basically means if you were to invest $100 into this ETF, you would be paying roughly 65 cents per year. And of course, if you were to invest $1,000 into this, it would cost you $6.50 per year. But what you are hoping for is the price of the stock to go up over the period of time so that you don't have to actually worry about paying that MER. However, with this high dividend covered call, it is slightly declining. However, we have to also remember that this is still a new ETF. It was first made back in 2017, and of course, recently we've had that downturn in 2020 because of COVID, and it is starting to recover. We have to remember that being what's in this ETF between this period and this period, it is mostly Canadian banks. Canadian banks did nothing during this time. As we can see, BCE is the largest holding, but from there we have TD, Royal Bank, Scotiabank, CIBC, Bank of Montreal. These are all banks that essentially did nothing for the past 3 years. From there, we've had Manulife, who does pay a high dividend, same as BCE. Enbridge pays a 7 or 8% dividend, and the same as TransCanada. And National Railway is also down there as number 10 as well. Next is the BMO Covered Call US Bank. This is personally my favorite ETF on the whole entire BMO portfolio list. This has by far made me the biggest return so far this year. It is absolutely stupidly ridiculous. From there, its average trading volume is 35,000 shares per day. I'm really surprised how there's not more people jumping on this one. It does have a high MER of 0.65%, which is generally the average when it comes to covered call ETFs. This one does pay a 7.5% dividend, but I grabbed this one myself at 10%. Oh yeah, that was way back when there was that big downturn that we had back in 2020. And yeah, that was fantastic. I've been getting 10% on this dude ever since like the middle of 2020. Oh, it's great. It was like 10.5 or something percent. Oh my god, this thing was a beast, and you should see how much it's come back. But that dividend is crazy, and we've got a history to say that this is not one of those average covered calls that loses you money. So we can see from the beginning to, of course, the top just before the coronavirus pandemic that it had a slight increase in price. Of course, there were some downturns, but of course the banks, all of the US banks, were going through that. And then of course the absolute amazing part about 2020, which sucked for 99% of the world, except for the 1% of the world who just had cash sitting on the side to invest in this ETF. Because you could grab this ETF at around $20, which I did myself, and from there, it's up to $30 per share. Oh my god, yes, 50% increase since the middle of 2020. And you're getting paid a 10% dividend. Now, I think there's still a lot of room for this thing to run, and of course, it's still not up to its $32.50 top, roughly $33-ish dollars, I think it was. I have to go back and double check, but at $33, it's easily going to hit that again, and of course, that is still a 10% increase on what it is now if it goes up to $33. And on top of it, you're getting paid a 7.5% dividend. This thing is a killer. And of course, it does hold a lot of banks, some regional banks, but mostly big banks like we're seeing here. Citigroup is a massive bank. JP Morgan is another one. US Bancorp is a massive one. Usually big banks are here. SVB is another massive bank. So, of course, Ameriprise is another one. But again, great companies, and it's a covered call strategy, so you're going to be making money off of those premiums. Next is the BMO covered call utilities. This is actually one that I do not own, and I would not own, and I've got my own reasons for it. Of course, utilities is not just Bell and TELUS and Rogers, but of course they do take up majority of this ETF. And the reason why I am not a fan of this ETF is because it does hold a heavy portion towards Rogers, TELUS, and Bell. The reasons behind this is because I personally think that SpaceX and their Starlink internet system is going to absolutely disrupt the whole traditional internet companies, and it's going to be an absolute just bloodbath, in my opinion. Because if you really think about it, we have SpaceX, who's bringing total wireless internet, where you get a dish, it beams down internet, you get internet. Now you're saying, well, what about cell phones? Well, guess what? They can literally put a tower anywhere they want with a couple of those satellite dishes on it to connect, and then transmit that internet through the cellular lines, I guess you could say, well, just wirelessly, 5G or whatever. And now you're probably saying, well, where would they get the electricity? Well, guess what? You can get Tesla solar panels and Tesla batteries, and now they're totally off grid. All they need to do is rent land from somebody, and there you go. There goes the cellular companies there. So this is why I think that I would just stay away from telecommunications companies for at least the next 5 to 10 years, because I think that it's going to be a bloodbath. But that's my own personal opinion. But this one does have a 0.65 MER. It does trade 218,000 shares on average for every day, and its yield is 8.16%, which is huge. Over the past couple of years, ever since it's been started, it started roughly around that 1340-ish range, and it did spike, and then it sort of went down. If we make this, let's call it a trend line here, and of course it did dip sort of a W over a very long period of time, and then it did spike up at just past 1450, but of course coronavirus hit, and now it's starting to recover. Do I think it could get back to this point? Yes, I personally do. But as we can see, it has TELUS, which is going to be disrupted heavily. Rogers, which is going to be heavily disrupted. BMO Equal Weight Utilities has BCE in it. That's going to be heavily disrupted, in my own personal opinion. And because of those three holdings, I personally would stay away. However, what we do see is pipeline companies that have very huge potential into the future, I personally think. Duke Energy has another very massive potential into the future, as well as the 10th company there. I don't know if you can see on the screen, but PPL is another huge potential company. But because of that ETF, TELUS, Rogers, I personally am staying away. Next is the BMO European high dividend covered call. This one is a favorite of a lot of people. The average volume is around 17,000. I know a lot of people do have this. I know a lot of people who have owned it. It is an interesting ETF, but at 7.3% dividend, it is interesting. But again, we have to remember that Europe is going to be they have had a lot of issues recently over the last few years, and they're going to continue to have those issues, and it's going to be worse with coronavirus. They have had a lot of issues ever since this ETF came out. Of course, we can see that it has declined. When you're having a covered call strategy, you're making a lot of the dividends from the actual covered calls that you're writing, or at least the ETF is writing. You're making the money on the premiums. However, what happens is if the underlying stock does not perform, your underlying stock value also goes down. Your ETF value goes down. Also, if there is a massive gain in price and somebody exercises those call options that you sold to them, you're now also losing money as well. So at the same time, you do not want to have a market that's doing absolutely nothing or less than nothing. You don't want to have a spiking market. You want to have a gradual increase on the covered call ETFs. And if there's a gradual increase, that's when you make massive amounts of money, because you're making massive dividends, but also a good, slow, steady, maybe 2, 3, 4% rise every year, and that's generally what you would want to see. This one does hold some massive companies, of course, Nestle being one of my favorites / in my opinion, best companies in the world. Whoever makes chocolate is amazing. And then this last one is not a 7% dividend ETF, but at the same time, I am adding this as to my honorable mentions because it does have a 6.5% dividend and, of course, high volume, which is great. But check this out. Don't you just love to see that chart? That is amazing. When you can have nice steady gains, of course, there's a lot of up and downs when you're looking at covered call stuff, but of course, nice steady gains over that time. Massive hit, nice steady gains again. This is going to continue. This is one of my favorite ETFs. This one does hold Bank of America, JP Morgan, Apple, Coke. Massive companies. Microsoft, not one of my favorites, but of course, if it's in an ETF, I don't mind it. IBM, kind of a scary company if you think like I do, but again, some massive companies that I really like. I hope that you have liked these picks. Again, never trust a random person from the internet, but again, I hope that this is kind of giving you some ideas as to what to look at to invest in, and I will see you guys again next time.